Want to wish everyone a good afternoon, good morning, good evening, depending on your time zone. We usually get people from all over on these. Also, thank you for coming to our panel titled, Why So Many Biopharma M&A Transactions Start Out as Aspirational Licensing Deals. That's a mouthful. I promise you it'll be good. This is on the heels of a publication that we put out at Locust Walk, a white paper called Bought Not Sold. And today we're joined by a great panel of experts to help us unpack how M&A transactions evolve in the biopharma space. We have 1 hour allotted for the panel, including questions that we have prepared in advance, as well as questions received in advance from participants. If you have any questions that you would like the panelists to address, please submit them through the Q&A system, and I will read out the most frequently asked questions, the ones that have the broadest applicability to the audience at the end or interspersed, depending on flow of the conversation. If we do not have time to address your question, we'll follow up separately with our thoughts. We will be and are recording this session, and a playback will be available shortly afterwards for attendees and those that could not make it. I'm also obliged to share that due to confidentiality obligations and other regulatory requirements, we will not address questions specific to any one company unless it's a deal that any of the principals on this panel were involved with and they feel comfortable sharing. This is also not considered legal advice, and it's also not an offer to buy or sell any security. Everything discussed is considered off the record. So with that in the rearview mirror, just to set the stage for the panel, Locust Walk conducted an extensive study of mergers and acquisitions in biopharma completed in the last 3 years and uncovered an interesting trend that leaders need to understand, that the majority of acquirers only became interested in pursuing an acquisition after they had a chance to view the target company's detailed data and financials in the context of licensing conversations. During this webinar, we're going to discuss why are most biopharmas bought, not sold, and why you should let acquirers drive the process. A little controversial. How many suitors you should have and how to fill your dance card, and how an advisor can assist in navigating this process. The typical milestone events and timelines for a successful acquisition, and when to time your outreach relative to data availability, and when also to pivot. So to dive deeper into these trends, I want to thank the panelists who have joined this discussion. I will introduce each of them briefly. So I guess just on my screen, I'll start with Naomi. Naomi Leslie is a managing director at Goldman Sachs. Her focus during her 11 years at Goldman is on M&A execution for healthcare companies, primarily focused on biopharma of all sizes, from large pharma to emerging biotech. She advised on a range of healthcare services and healthcare technology companies as well. I have Tony Givney, who is the CFO and CBO, double duty at Fog Pharma. He oversees and drives the business development and finance functions of the company. He has over 25 years of investment banking experience dedicated to advising biotech companies in the US, Europe, and substantial corporate M&A partnering transactions, as well as executing financing transactions. So welcome, Tony. And we last and not least have Andy Meyerson, who's a managing director, head of North American strategic transactions at Locust Walk, a global life science transaction firm. Prior to Locust Walk, he was a corporate attorney, recovering attorney at Gunderson Detmer, at Wilkie Farr and Gallagher, and was also a banker at Credit Suisse. I don't know if I've ever been on a panel where there's 4 current or former bankers, but there's probably a joke in there somewhere that I'll think of by the end of this panel. And separately, if you have any curiosity as to any funny stories about Andy, we can talk about that offline, and maybe you'll figure out how I might know them. But anyway, without any further ado, I'm going to dive right in and get going. So our analysis showed that the vast majority of acquisitions of the emerging biotech companies by the larger companies initially began as a licensing discussion. That's not a surprise because that's the topic of the panel. So why? Why do you think that is the case? What's driving this? Maybe Naomi, I'll start with you.
Sure, and I think we even look, broader at public company M&A. I think 85% of deals start as a licensing discussion that then pivots into a whole co-M&A transaction. So in terms of why, I think it has to do with the broader biopharma M&A dynamics that we observe. And as you noted, it very much is bought, not sold. So it's offensively minded is the way buyers behave. So in order to go on offense, you need to be educated. So partnerships and licensing are a natural way to want to educate the universe so someone can get that activation energy and potentially want to pivot to buying the company. It also, from a buyer perspective, makes sense. It's less capital required. You can supplement the pipeline. You get educated, you get to due diligence without really needing the price of admission of a whole co-offer. And from a licensor perspective, from a seller perspective, right, it makes sense in some ways to license. Maybe it's the right way to finance the company at that point in time. There's clearly a lot of geographic elements where maybe you're not going to commercialize or develop ex-US or in China, that it makes sense to have those selective geographic licensing discussions. And then there's natural pivot points we can get to about where would that licensing discussion go and become a whole M&A discussion, and what drives that. I can pause there before I get into that second part.
To follow up on that, so do you think that a lot of these companies are having the licensing discussion expecting that it's going to go to M&A because that's the strategy, or it just happens to evolve that way organically?
I truly think it is both. I think it started out by evolving organically from the licensing discussions to a buyer deciding, either the amount of capital they want for licensing makes it more sense for me just to acquire the whole thing, or as I look at this asset, there's a certain level of control I need to have, and therefore I need to own it, not license it. Or the licensing discussion is for such a big part of the company says that is a whole co-offer. That's not going to be a licensing discussion that you want. So I do think originally it starts organically. I do think as you think about, do you auction off the company or put a for sale sign up for the company? There's kind of in biotech a subtle sale process, which is opening up and educating via licensing and then seeing if Wholeco materializes.
So it's basically like, you want to ease your way into it. You don't want to ask for the marriage proposal. You want to date first, and that's the effective dating. So Tony, I'm curious in your experience, both obviously not just at FOG, you were at a prior company that got bought, and obviously as a banker, how do you think about the transition from license to M&A, the why and the dance around that?
Sure. Well, first of all, Jeff, thanks for having me on the panel this afternoon. And you're referencing my time at Achillion. So I was there for about 15 months, and we can certainly, because it's publicly disclosed, the process, explore that. It's probably reasonably topical for what you uncovered in your analysis over the last 3 years as well. So I think the question is interesting because I think we're in a bull market, right? We're in an environment where capital formation is readily available, and I think that ebb and flow of M&A in some ways is sort of tethered to the ability of emerging growth companies to continue to really grow through the capital markets and always weigh that decision. Is now the right time to even entertain a sale of the company, or we just continue to plow forward, diversify the company, add more value, and maybe even broaden the appeal of the company if ultimately a sale is there. So I think when you have that strength of the bull market that we have, where whether it's a platform company, early stage, or even through very advanced companies, you always have that fairly natural trade-off. And so it actually emboldens the biotech companies to be able to go after partnerships, because maybe very legitimately that's really what they're looking for. But as Naomi said, ultimately the control of key assets within a company becomes a very expensive and probably strategically limiting outcome if you give away too much to a partner. There are definitely examples of a non-partner acquiring a partnered company, but it tends to narrow the field, and it tends to have the large acquirers do less work on the company than the companies that are unpartnered. So I think a lot of times, to your question, it starts off as partnering, because I think actually biotechs would often want to do that if they can actually hold enough rights to become strategically interesting down the road.
Interesting. So Andy, I'm curious your take on this. I know that you've worked on a couple of deals that have morphed from license to acquisition, and how do you think about, again, the why and the dance here?
Yeah, so I think Naomi and Tony really hit the nail on the head in a lot of ways. I mean, if you look at the actual deal activity within biotech, the vast majority of transactions are partnering transactions of some sort, whether it's a license, a JV, whatever it is. Most deals that are happening are not M&A. Maybe it's a setup for an M&A, for Tony's point, but that's really the majority of types of deals that are happening. And so it makes sense that that's how conversations would start. And I think from the emerging biotech's perspective, when you're heading off into one of these types of processes, there's sort of a certain cadence and expectation if you say, okay, this is an M&A process, especially if you're a public company. There's sort of expectations on the buyers in terms of how quickly they have to react and what do they have to do and can they get up to speed and what's the offer on the table and all those other sorts of things that you can't slow down. Once you set up the process, people are pretty capable of identifying where the bluffs are or not off your timelines based on how you react to them. And what a licensing discussion enables you to do is to be able to take your time and be able to start off with a range of possibilities in terms of what are the ways in which you could potentially work together. I certainly have my preference as the smaller company, want to get your perspective as well. And through those discussions, you can start to see where the cards are gonna fall in terms of how that process is ultimately going to work. And from a buyer's perspective, I think that Tony had it exactly right, and Naomi as well. It comes down to the assets and control over assets. And the buyer takes something on because they like the assets. And what is the transaction that I have to do to get the asset that I want in some way? And in some cases, it turns into, you know what, this is going to have to be an M&A because I want to have control. A license isn't going to get me what I want, or a license is all I need and that may be cheaper. So that's what I'm going to pursue. And I'll deal with the collaboration and the complexities that may be a part of that. So I think that you have to always look at these from both sides' perspectives. And from the buyer's perspective, the more that you can give them their own range of options, probably the better off you'll be, because that way they arrive at their own conclusion, which may be what you're looking for anyway.
So Andy, I heard a couple things in there. So one, the ability to get more people to the table in a slower fashion to reveal more over time gets comfort built so that we don't have to run an auction and people make decisions in a vacuum quickly. That might actually get more competition. That's interesting. But I think the follow-up to that is, if you're the small company and I imagine a lot of folks listening to this webinar are thinking not just, hey, how do we think about acquisitions as an afterthought, but intentionally drive the license deal into an acquisition if that's really the outcome. How do you get in the head of the big company to shift their focus so that they come to their own conclusion that I have to buy it versus rent it? If you just finish that thought off, Andy, then we'll go back around.
No, absolutely. And it's the right question to be asking as well. And I think that a couple of ways to think about it are, one, very rarely in biotech are conversations happening in the vacuum. There are catalysts for transactions, whether it's data readouts or some other key piece of information that is really going to be sort of a de-risking trigger for a potentially significant transaction. And so it's understanding how do you build that into your thought process as well. But really what it comes down to, if you're trying to steer someone in a different way, it's what is it that you're actually communicating to them in terms of what it is that you want? What is it that you are going to require in a deal, a license transaction, for instance, that you're going to say, if you want this asset, this is what you're going to have to give me in terms of control. Am I going to demand the co-pro, co-dev? Am I going to ask for whatever XYZ it happens to be in the deal? And using some of those types of arguments, you're able to potentially transition the transaction into being a discussion around, well, if you don't want to give that to me, or if you're asking for this, that's a different thing that's going to require to get me to say yes. And so you can start to open the door a little bit along the way in terms of how the nature of the discussions go. And it's very much a push-pull. And a lot of times it's really helping the buyers realize that, okay, what is it they actually want? And so if that's what I want, what do I have to do to get it?
Yeah. So Naomi, what do you think? How do you subtly get the buyer to want to buy you if that's ultimately your goal of the process?
Sure. I think there's two things I would layer on to what Andy said. So one is, in that licensing discussion framework, what you also facilitate is consensus building at a buyer, right? There's so many different stakeholders. There's the clinical side, the R&D side, the commercial side of things, right? You need unanimity across all those different functional areas to decide this is an asset we like and want to have or in-license or own and take to market. So there is the benefit of that building of consensus that will help someone get to the offense, right, where they want to make that bet and buy the company. For you as a seller, the way I have done it in the past is you're in discussions, someone wants to partner an asset, that's a lead asset. And essentially the response is, look, if you want global rights to this asset, right, if the US matters to you, that is my company. So that is control of my company. So the only way you get that specific piece, so the way that you're going to get US control or US co-development, co-commercialization, is if you buy the entire company. And that is our board's perspective. So it's essentially getting to the point where the asset that they covet is truly what drives the whole company value, and telling them that they have to think of whole company terms to get that piece of the business.
So if I can just dig a little further into that. So it sounds like the opening salvo of what you're willing to part with is anything but US rights or but co-pro rights? Where do you typically think you draw the line where you can attract license interest, then they don't need to buy you, or you attract license interest, but you're holding too much back that they have to buy you? Where's that balance?
So I would say that the typical cadence and the typical way it starts is typically geographic. So on geographic limitations, as an emerging biotech company, you can't commercialize globally. It's most natural to focus on commercializing domestically, given the way the profitability splits across the world. So a natural beginning of that discussion is ex-US or certain regions. It can be Japan, it can be China. Just starting with specific regional discussions is typically an opening to start educating a company, facilitating them to understand the clinical data better, and again, build that consensus and build that activation energy and excitement. So I'd say the most typical way you see it is around geographic lines as a way to do that.
So would you offer a co-pro in the US off the bat? I mean, I guess if that's what you're looking for, you got to do it, but you might just not offer that up front, so that way there's more of an impetus for them to flip.
I mean, it truly depends what your goal is, right?
Sure.
If your goal is, I want to sell the company or I'm not interested in any transaction, then that's one thing. If your goal is, I would consider a co-development, co-commercialization in the US, you can say that, right? But maybe you say, but I need to book revenues, right? You can put in the framework of what you think really matters to you, put out there your optimal structure, right? So maybe we can do co-development, co-commercialization in the US, you need to cover this cost. I need to book revenues. You will get a profit share, right? Put it out there what you optimally want. And then their response to that could be, well, that won't work for me. I'll just buy you instead, or counter with that. So I think that's another way to do it. If you want to guide it to actually having a co-co deal as your backup plan to a whole co-acquisition, that's another way of doing it.
Got it. Any thoughts on this, Tony? How to drive the conversation that way?
Well, I think one aspect, it's really important if you're going down a licensing or a co-promotion dialogue that you're in front of the decision makers who can pivot, and sometimes in a public context, they need to pivot from a licensing discussion to entertaining a reactive bid if somebody else steps forward in a matter of 2 or 3 weeks sometimes. And so the ability to actually have the head of R&D, the head of commercial, really know the company, be current with it. Sometimes that makes all the difference in their viability to really step in and know that they have to be probably more aggressive than they would plan to, because obviously there's somebody else who's at the table. But in terms of the dialogue with the company, I mean, you can often sort of hide behind your shareholders, and you can obviously hide behind your board and say, the external expectations are X, Y, and Z. That we are a phase 3 oncology company. We are an ultra rare disease company with pivotal data. The world knows that this can be a profitable product for us. It can be the nucleus of growing a big company. For us to derail that expectation, it's got to be extremely compelling. And the conversation can even be not just one way. It can be, do you commingle assets? Do you go after something together? And do you really want to bring something to help our business grow in a disproportionately strong and comprehensive way? And if the counterparty can't offer that, then they've got cash, right? So there's a lot of ways to sort of say, help me build my company. And if it looks like you covet the asset and we can't find that way to do it, then ultimately, I guess I work for shareholders, right? And it's got to be very compelling, and it has to almost get me what I think I could operate myself into in terms of value down the road in the not too distant future.
I mean, I think what you're hearing all of us say is essentially you have to know what you want before you go into the conversation, whether it's part of the licensing transaction too. You have to know what you want to suggest, and you have to know what is my optimal, to use Naomi's phrase. What is it that you really want to put in front of them for something to react to? Because you're going to get the question. They're going to say, what is it that you're looking for? And you have to be able to say something along the lines of what Tony said, or be able to say, I want to do something ex-US. I want to keep the US for myself. I want to do co-pro, co-dev, whatever it is. You have to go into the licensing process and those discussions with that understanding, so you know how to respond.
I mean, if I could just amplify one more thing, it's really important to be consistent and have a message that if it changes for a reason that is actually understandable to the other parties, because nobody likes to feel that they've sort of been, in the business development side of large pharma, large biotech, they don't want to feel like they're being sort of tooled around and being led to something. Then there's a pivot. If there is a sort of a growth of the story into, well, I guess it's going to have to go down to an M&A outcome, because they become the ones to say, are we being driven to a third party buying us, or are we being sort of strung along in a way? So it's really important to have them understand why, if your goals are changing or if they're just consistent, why it makes sense for you. Coming back to, what is your promises to the street, and then what's the expectation of your 20% owner, things of that nature. Those are very important, consistent points to bring out.
So on that note, I mean, our analysis was just on public companies because that's the only data set that's available. Everything else is confidential and/or anecdotal. How do you view this dance changing if it's a private company instead of a public company, where the private company can just say, no, I don't want to get bought out, because they have more flexibility? Is there any difference in your mind in how to approach the flip from a license to an acquisition, or give me some color on that? Maybe Naomi, if you want to go first.
Yeah, the few things I would add to that, I think so overall the construct of licensing leading to M&A is consistent, whether you be public or private. I think the real difference comes as a private company. Who are your key stakeholders, right? So it's much more long-term shareholders versus your shareholders that are that day. You might be in it for a quarter, 2 quarters, a few years, right? So you have different stakeholders who determine their investment horizon and their expectation for the return on that investment. So different hurdles. I think the second option, when you think about being a private company, is what are your alternatives as a private company potentially going public? And I think you'll see a few examples of this where companies are acquired shortly after going public. I believe Pandion's a good example of this with Merck, right? They had licensing discussions pre the IPO. It became clear to them going public was a better option to maximize value, went public, and they got a premium on that IPO price eventually from Merck. So creating tremendous value just by thinking through full options as a private company with the capital markets and getting a Hilco premium on that. So I really think the difference is your options are different, right? What is your option to that takeout? It is potentially going public, depending upon where you are in your development and your maturity. It's the stakeholders, so really the investment horizon and threshold and return expectations from those investors, which give you a bit more leeway in terms of what you want to think through in terms of your options and your response.
So I guess maybe it's just because the market is so, in historical context, so open, but why do you think there aren't as many private company acquisitions on the doorstep of an IPO? It's happened a couple of times, but that used to be much more frequent. I'm curious, is there anything beyond just it's easier to raise equity, or how has that dynamic shifted?
I think the stats would be, I think typically if you look at when after a company goes public, how frequently is it that they get acquired? I think on average, it's a year and a half, 2 years, right? It's rare it happens within the first 12 months. And I actually think the biggest factor of that is just when is the catalyst? You think about going public, you're probably funding through a next catalyst event. Typically, you're going to have 2 years of cash on balance sheet. So when do you actually drastically change as a company, right? Become less risky, have a de-risking event, have a catalyst. I think that truly is more what determines it in terms of when you become more appealing or attractive to a buyer because your risk profile has shifted. And particularly now with preclinical companies going public, right? There's even probably more de-risking that might need to occur to get that willingness to put that money up front.
Yeah, I think a lot of biotechs are looking at where the public markets really just unlock value compared to the private market. So if you're looking at the step up of whether you're doing a public round versus a private round, it's often in the 2x plus range, and you're getting that benefit from for well executed crossovers, and it kind of moves forward. I do think that the credible threat of an IPO can really push buyers to try to get in front of that. And there was a recent one out of a West Coast drug discovery company where they went for a very big number, likely well ahead of what the IPO would have been, but there's probably a sense that it would have unlocked to that value. So I think you have a lot of ability again in a can-do equity markets to get to that. I want to echo what Naomi said as well, which is that when you have over 25 preclinical IPOs in the last 12 months, which is almost unprecedented by history, in some ways that's not really a market for acquisitions. Very few platform companies are acquired before they really become product candidate companies. It's simply because that's what I think large pharma and large bio would rather rent through partnerships as opposed to own. Even if they love the platform, they're worried about the talent leakage that comes out of those companies being acquired. So it just is a model that it doesn't really connect well with M&A. I actually just did in preparation here. There's been about 13 acquisitions over $1 billion in biotech this year, but there's $150 billion companies in the NBI today. So it's one where, and a lot of them are earlier stage companies, so there's disconnected from that transactability from an M&A perspective.
I think one other thing that's also important structurally about private companies that are not true of public companies, it gets a little bit to what Naomi was saying about stakeholders, is that your fiduciary responsibilities as managed on the board are also different. There's a different dynamic at play, where when you're public, you do have to worry about your legal responsibilities in terms of weighing an offer that comes in, and how seriously do you have to take it, and how do you have to analyze it, and what do you have to do in terms of running a competitive process, et cetera, in terms of what is the ultimate outcome going to be. And because of the risk of shareholder lawsuits and such, there are some times where the M&A almost becomes inevitable, where it'll almost be challenging for you not to accept the transaction and be able to justify it to your own shareholders. When you're private, none of that really exists. And so if you are in a dynamic where you have the optionality of being able to pursue an IPO or pursue a transaction or do something else, you're well-funded, your investors are continuing to support you, you're not in a spot that you have to do an M&A, because you can simply say no to somebody and they know that there's nothing else that they can really do about it if you say no, other than maybe increase an offer or do something else. It's a slightly different leverage point and a different type of discussion as a private company. And if there's a valuation disconnect, that's why people tend to go public, because they know they'll get the benefit in the public markets. And then if you still want to buy me, do it with my equity premium.
Wow, there's so many good comments in there. I'm not even going to try to summarize all that from all three of you, and there's so many more topics we can go on. So I'm gonna leave that there relative to kind of the conversion from licensed M&A, and maybe shift gears slightly to this was actually a very interesting finding, that there's very few competitive bids, and that for the most part there's only one bidder. In some cases there's multiple bidders, but at least what's disclosed publicly for some of these public M&As, there's only one party that ends up putting in a real offer. So A, why do you think that is? And B, why don't pharma companies know that you're just not, they're bluffing and they don't need to do something? So I'll let you go first this time, Tony. How do you think about the competitive aspect of these deal processes?
Yeah, so it can be a little bit of a misnomer that there's only one party, because a lot of it has to do with the tactics that the acquiring company and the aggressiveness of the timetable that the acquiring company is pushing on the target, that maybe dictates and shrinks that playing field, quite dramatically. Again, I'm a few years removed from banking, but I do recall very fondly the fact that when you really have effectively a soft bear hug letter going into a board, you have an aggressive price. The messaging from the bankers has to be in some ways qualified, saying that we know you're current on the company. We encourage you to take a look, and by the way, you've got 14 days. That's just a very unnatural ask for a company when they know that there's an aggressive bidder who's probably going to counter again, who's already gotten to that point in time. So if anything, it's trying to give the acquirers the time they need and being able to get them up to speed to create a more competitive landscape. And that's where a good M&A banker can start to broaden that out in very subtle ways, so people get ready for the call that's going to be coming officially down the road, things of that nature. The other aspect of it is there's just a lot of companies, and these acquirers, they have teams of 50, 80 people who are diligencing every company that is strategically making sense to them, and therefore they have their bets, and they have those bets that's at the right time for them, and that's not often connected with other buyers as well. In some ways, the larger, the more well-known, it can become a little more competitive, and maybe the interest is a little bit more bespoke for companies that are more, that are a little more speculative.
So let me push back on you a little bit there. Then what about this whole idea of a licensing process to get buyers comfortable, expand the universe, and get everyone to hopefully a similar spot, such that if an offer comes in, there's more than just one party ready?
So there aren't a lot of companies that do sizable M&A deals, and they call that maybe 500 million and higher as a serial acquirer. There were certainly several years ago more acquisition-driven companies, but it becomes a little more of a balancing act. And when again you have 150 publicly traded companies worth over $1 billion, that's just the public side. So you have a fairly scattered set of opportunities, and therefore it's a little bit of a law of the numbers, and so certain assets might become more broadly coveted because they have a spectacular product, but they're usually priced accordingly, and they price out in the number of buyers because it's the public markets have driven it to perfection, and you have to think if the numbers can work. So a lot of it has to do with those dynamics. I'd actually probably venture to say if the capital markets dry up, you probably have more acquirers per acquisition. But again, when you're chasing nosebleed territory on NPVs, it narrows it down pretty rapidly.
So let me reframe the question then for Naomi. So is the competitor not other pharma companies, but other investors continuing to fund at super high prices, such that you're only going to get one bidder willing to, because that has to be a deal they have, and the company can always say, no, I'm just going to keep funding. Is that the dynamic, or is there something else?
So I think those are the two kind of big parts of the dynamic. And just to double click on both of the concepts you raised. So first on what is the competition? I think it's right. The competition is rarely another bidder. Competition is conviction in my standalone pathway. Conviction, if I keep funding this, what could my stock price get to? And this isn't sufficient for what I expect that I could do. There's been some cases where partnership has been the alternative, right? This is a great partnership term. I still get to keep my lead asset. This funds me going forward. There are alternatives. And so that is what puts the pressure on a buyer, is that you have options. And really the best alternative is my conviction and my go it alone pathway being superior to what you're offering me today on a POS adjusted basis. I think the second driver of this is you have to realize and recall that in biopharma, what we have learned is you win by going on offense. So I think it's something in almost 9 out of 10 deals, the first bidder is the winning bidder. So that trains behavior. So if I am a large pharma company, what that says is if you want an asset, you have to find it first and go after it first, then you are most likely to own it. So when someone shows up to catalyze a process, they've done a ton of work to determine this is the asset that I want. The stakeholder building internally, they're getting consensus of leadership and management to write that letter and say, this is the asset we want. We're now willing to put a premium on it. You have a buyer that doesn't want to lose. So I don't think they're being silly with their money and bidding against themselves. What they've realized is I'm not going to lose this, and I'm not going to be a quarter too cute or a dollar too cute, right? I've done all this work. I put in the letter, I want to win. I'm going to do what I think it takes to win. And from the advisory perspective, that's what we get told by our clients, right? We decided this is the asset that we need. It fits our portfolio perfectly. Maybe I'm unique in the combination trials. I can run with it and I don't want to lose it. And so when someone tells you that mandate, you're going to tell them, okay, just pay a little bit more and we can get there.
Interesting. So, and I'll get to you in a second. I guess then the follow-up question is how would somebody position themselves as a buyer to, is the idea of someone being a stalking horse buyer really not valid anymore if you're going first and you're putting in the first bid and you're going to play to win? Should the sellers not think about trying to get a bid just to start an auction, but really think about that first bid as the likely buyer? Because you just told us from the buyer's perspective that that's how they're thinking about it. So if you're a seller, should you assume that's likely going to be your best offer or your best partner and not just a stalking horse to start a process?
Just tying a few things together, right? So if you've done an expansive licensing process and pivoted to M&A, you know where everyone stands, right? You have a very good idea of where people stand on your company, your lead asset. What we're seeing even now more and more frequently is in licensing proposals, buyers will say, if someone puts in an offer for the whole company, please call me because I too would be interested in the whole company, right? So you will be very informed who's interested, who's even been explicit. Again, because of this offensive behavior, fewer and fewer market checks, first bidder wins. You now have companies being explicit that they have interest, right? Please call me if you get a whole co bid. I have interest. I want you to know. I've had I've had large pharma tell clients, I'm planning on trying to put a bid in for you. Just give me 2 months to finish the internal process. And like, I promise you, I'm going to show up with a bid for your company, right? Being incredibly explicit that that's the intent. So you will be very well informed when that bid shows up. Who else has told you they're interested? Who included in their licensing proposal? Please call me if you get a whole co bid. So you'll know what are those select calls you do make, because who could be there. And yes, in 9 out of 10 times, that initial bidder wins, but there's still that other remaining 10% where it is someone else who wins.
Yep.
And so you don't want to be missing out on that opportunity either. And there is, on the public company side, the fiduciary duty component as well. So you want to make sure you are doing that duty to its fullest.
Of course. Andy, do you want to comment on any of this?
I mean, I think Naomi and Tony really hit on the head about a lot of this. And I mean, I guess the ultimate question is, why does the bidder increase their bid? And I think,
how do you maintain, that's exactly right. How do you maintain the pressure? How do you bid that up?
Right. And I mean, part of that falls onto, I know one of the other things we were talking about is the role of an advisor in terms of what to do, and
it's coming next.
How do they start helping? And, you know, don't mean that as a self-promotion or anything, but part of the way that this works is when the bid comes in, understanding, okay, what is their perspective on value? You've already had discussions with them to understand strategically how you fit. And a lot of this is helping understand, okay, what's my value? What's my value to them? Let me put myself in their model with their own synergies to think what their ability to pay actually is, to what point should I actually be willing to say yes. And part of it also takes, you know, intestinal fortitude to say no to somebody when they already put an offer in front of you that you'd probably be happy with, given that there's already a premium involved. But it's, you know, thinking forward about, where is my company going to be if I were to do this myself? If I were to raise that, you know, $75 million and fund the next trial and do whatever, what would it be worth then? And being able to Tony's earlier point, clearly articulate to the counterparty why the offer is insufficient and help guide them to where they ultimately need to be, to give them, you know, the right type of range to be able to say, you know, if you're in this area, or maybe you leave it open-ended, depending on the situation, we think we can make this work. But when you do that, you obviously have to then be truthful.
Yep. So
I might just add, if I could, Jeff, again, the disconnect between what boards know and what the public knows is a big driver as well. You know, there's open label data, which is not in the public. There's catalysts that are not in research analyst models. There's knowledge about competition that maybe isn't out there. There's a lot of things that you can use to really drive value, even if there's only one natural buyer that says, you know, look, the answer is going to be no until we get through that threshold. And by the way, you know, you know something the public markets don't know. You need to pay for that. Otherwise, we'll wait for it. You know, that's a big part of public company. I imagine on this webinar, there's a lot of private, you know, companies who are listening in, and on the private side, it's not that different. But in the private side, you have one key lever, which is beneficial, which you have structure. You know, you can do far more structured and tailored outcomes to satisfy your shareholders than you can as a public company. Very few public deals. I mean, I think there's 2 or 3 I can think of. There's actually a below market up front compared to where the stock was trading. It's almost impossible. But you can do very structured, back-ended, NPV enhancing type of transactions that look a lot more like a quasi-licensing or partnership in the makeup of that. And it helps keep you from having to build the infrastructure to perform.
Makes total sense. So just on that bridge, and this is not a self-promoting conversation, but I do think it is important to understand the role of an advisor, because that is critical to the dance to hopefully improve deal value. And I imagine that Naomi and Tony, you'll have to use your experience as in your current company, but also as a former banker, and Naomi, obviously your current job. Andy's role is a little bit different, where we spend a lot of time on licensing. So maybe I'll start with you, Andy, just how you think about the role of an advisor for someone like, again, try not to be too promotional here about Locust Walk versus a classical bank, and when to bring in whomever to optimize value.
So I think that a lot of the answer to that is really driven by the organization yourself and who's internal, what's the level of experience they have, what is it that you've been able to do before in terms of your experience set to draw from. I mean, the real benefits of bringing an advisor, as I see it, are basically threefold. One, we talked earlier about knowing what you want to communicate. What is the type of deal you want to look for? How should you be thinking about value? What types of structures, et cetera? that's an area where an advisor can certainly be helpful if it's something you haven't really been able to think through yourself, to make sure that you're going off into the marketplace with an understanding of what it is that you ultimately want and how do you communicate it. A second place where an advisor can also be really helpful is, and it's sort of a blend with the third, is an understanding of how the counterparty organizations are structured and function, knowing who to talk to, understanding what their internal processes are, how do their timelines actually work? When they tell you something, what does it actually mean? Being able to help you navigate those waters from the opposite side of a transaction that, Goldman was working with Merck with Acceleron. I'm sure that there's a lot of committees along the way to get Merck to be able to move forward on that deal. And so understanding how to navigate that from the opposite side of the table ends up being valuable because it helps you understand timelines and who's going to be around the table and everything else. And then the third area, again, as I said, is people who have seen a number of transactions, who have seen a lot of things that can go right and a lot of things that can go wrong, are helpful in terms of being able to help get out ahead of what's about to happen. And that's true whether you're in the licensing discussion, it's true as it translates into the M&A discussion. Having an experience set that you can draw from is going to be valuable. And maybe you have it all internally already, such that you don't need anybody. But if it's something that you feel you may have a particular gap on, that's really where an advisor can really help set in. And especially in the public company context, it's almost at this point a requirement that there's an advisor involved for legal and other reasons.
Yep. So just before we move off you, Andy, so since Locust Walk tends to focus more on licensing than M&A, but some license deals that have been done have converted to M&A, how do you think about the timing of engaging a group like a Locust Walk versus a Goldman or a Merrill or Leerink, like where Tony used to be?
Yeah, so I mean, like you said, we're a little bit different in that we focus a lot more on collaborations and partnerships, and as opposed to straight M&A in terms of those discussions. And I think Naomi can certainly weigh in as to when it's best for the Goldmans of the world to maybe get involved into a discussion. Then to be clear, we fit in very well with everybody, so it's not like it's to the exclusion of anyone. The way to think about it is really being able to look at your own corporate development timelines and catalyst calendar and figure out when will a transaction window potentially open, thinking through what is it that I would actually want in that type of transaction, and then how do I start the process of educating people that's going to enable you to have conversations occur on a timeline that is beneficial to you. If you finish your phase 2 and you have to know whether or not you're going to have to start a phase 3, well, you should probably start talking to people before the phase 2 is actually available. And so that they have an ability to be able to learn about the trial, see the data, or tell them when the data is coming so they have something to look forward to, and really start to prime the market for what's going to be a major value catalyst. And then hopefully be able to time a transaction off of that enables you not to lose time waiting for a deal to occur.
Yep.
Or at least make a determination to know that I have to go forward on my own. And so I think that's really a lot of it, is being able to look and say, okay, if I know how long these processes usually take, and I think we even showed in the own white paper, about a year to go from first conversation to close M&A. And so it's a pretty long time. You don't want to be sitting around twiddling your thumbs for a year. You can almost start to layer in, when do I need to start talking to people, and what types of conversations do I have at what point in time based off of things that are happening in the world.
Cool. It makes total sense. Naomi, in your experience, I know you're in a slightly different size-wise and transaction type, but when do you typically like to start involving yourselves in the process versus when you actually get engaged, and how does that transition look like?
Sure. I mean, overall, I think a key part that you've heard throughout this discussion, right, starting with licensing, M&A being offensively driven, a key component of that is just knowing the landscape and knowing the key players. And I think that's a key role of what an advisor does, is just facilitate introductions, right? So when I think about our involvement with the company, we get involved fairly early on. Typically, we take a bunch of companies public. So clearly we have pre-IPO relationships, but on the strategic side, tends to be a bit more active in the post-IPO stage. But a lot of what we do as part of our coverage effort is make sure you know who you should know, right? We have companies come to us all the time, huge, large pharma companies who have a huge BD army, leaders in their therapeutic areas who regularly will be like, look, tell me 10 companies I don't know yet, right? I always want to make sure I know the next thing. Who did you just take public? Walk me through them. I want to make sure I get to know them. So a big component is making sure the people who know you, right? And there are so many companies for everyone to keep track of that I think we play a really critical role in facilitating those relationships. I think another key thing to build on what Andy said about the role of an advisor is really that trusted credibility and messaging to a counterparty. Right? Two people could read the exact same words, but it'll mean very different things depending upon who it's coming from. And part of having folks who are in the regular flow of business, talk to these folks all the time, is they can be really tailored and specific and know how to communicate really effectively what the message needs to be and get that message across more effectively than someone else. And the last thing I just note on the advisory side is it's also good to have a mark-to-market perspective of what are the watch-outs. I think about 2021 year to date, and we spend now so much of our time on the FTC watch out, right? How should we think about constructing agreements and contracts for a longer time between signing and closing? How can we better understand that risk, get paid for that risk we need to take on, have options for you to keep funding should this take longer to close than anticipated? And so I think part of being just in the regular flow and mark to market of key contract issues also helps make sure you're getting the best agreement.
Cool. Tony, any thoughts here?
Yeah, I might say from an advisor perspective that there is a different, I think, level when it comes to M&A advice, particularly, in the context of a public company or even private company where it's really change of control versus licensing. I'd say the best advisors can really get clarity from the buyers, and clarity can be, I like this, but this is fifth on the list of things we really care about. That's the type of answer you never get as a management in direct dialogue with that company. Really understanding, is this something that they're going to be pounding the table on, or something that they're probably going to be a follower on? Is there a blemish that they don't want to tell the company? Those are things that the long relationships can probably subtly message, and that buyer will be able to trust that the investment bank who's hearing it is going to filter in a way that's not going to sort of betray their confidence. There is that in-between role, which is very important. I think it also does matter in licensing. It tends to be a little bit more in the background than in the foreground in the context of it. So there's a more of a focus on the modeling, on the structuring, on trying to time it, trying to think about capital formation, versus partnering. That's a lot of the work that I think an advisor can do. And I think, like Andy said, it's usually a balancing act between what the companies can do internally versus what they really need to outsource. Sometimes just a matter of bandwidth, and oftentimes just a matter of, there's key relationships, or there's key skills that a certain firm will have that you want to gravitate towards. I do think it's helpful to have advisors on that if there's a pivot, they can take you pretty far down the road for something that's more change of control, as opposed to something that is sort of purely partnering, because otherwise you have to sort of get that going again.
It's an interesting point. I mean, I think one of the big things to remember is, especially in a licensing negotiation, right? And so something that's not a change of control, maybe it turns to a change of control. But when you're in the heat of a negotiation, there's sometimes certain messages that have to be delivered, to which having relationships are helpful. But then it's also true, once the definitive agreement gets signed, both companies are still around and actually have to be friendly with each other, because there's some sort of JSC or otherwise in terms of governance. And so having an advisor on board is another mechanism to enable the deal to be, in some cases, decoupled from the alliance management relationship. And there's a reason why big pharmas have the transaction team separate from the alliance management team. It's a different person that you have to talk to. And you may have built a rapport with somebody during the deal that's a little bit different from the day-to-day. And so I think that the role of an advisor also is enabling the company and who's going to be surviving and at the end of the deal to be able to help message things appropriate and move them forward, where there may be a hard message that has to be delivered. It may be something that you have to appropriately massage, and it's better to hear it from me than directly from the counterpart, or vice versa.
So one last thing, and we'll move on to kind of the last topic, is I actually think that advisors should be engaged before the offer comes in, because that's the first conversation you're having is, hey, I just got this great offer, or reasonable, or okay, or even bad offer. What do? I want to hire an advisor. And if you haven't had a relationship already, you're behind the eight ball, and you're probably going to end up losing a lot of value from that. And that's just a general piece of advice, is just continue to talk to the folks who can take you public, or if you're already public, who are your bankers. Build those relationships early, and don't wait for an offer to start that dialogue. Do you guys agree? Good.
Yeah, very much so. Especially, that also means that you weren't prepared when you received that offer. So in that important interaction, whether the offer is accompanied by a phone call or a dinner, you might not have said the right thing to ensure you're preserving optionality and maximizing value.
Yep. So one last topic that I thought was interesting, and it kind of came up a little bit earlier, but the idea of platform companies versus product companies. And is there any distinction between these two when you're entertaining these M&A type of discussions? I've certainly seen situations where pharma companies, actually in most cases, destroy value once they've acquired a platform and don't do anything with it. So I'm curious how you think about the M&A bid on a platform company versus a product company, and are there any differences between the two? Maybe Tony, we'll start with you.
Yeah, I think the acquisition of a platform company, again, early on in its product development horizon is atypical. There's probably one or two a year. Certainly of a size of consequence. There's some micro cap ones where you're filling in. There's some hot areas where people want to buy their way into a technology, whether it's gene therapy or something of the like, where it feels that that's a platform, but it's also sort of an external skill. And hopefully they can motivate the right people to really have it become a business for the company. So it's a little bit more of a bespoke model around platforms. However, platforms that actually have assets that kind of lead the charge, that helps in some ways to sort of justify paying for the platform, which has proven that it has a level of productivity, in order to make that sort of more of a change of control type of outcome. The alternative is that, in an era where obviously, cash on a balance sheet for an acquirer is about 0.5% at best, there's just an environment where if you really want to be able to have something productive, you can pay very handsomely in upfronts to be able to gain access to that platform. And that's a way to have it be a non-P&L hitting way to access targets that otherwise would not be available to you. So in some ways, that's sort of the perfect outcome for a platform company, because they're staying in control and they're monetizing their platform while they still get to drive a business. And so it's kind of considered like half of an M&A.
Naomi, any thoughts about distinctions between platform or product companies as it relates to the M&A process?
Sure. And I think a little bit more about it from a buyer perspective and an evaluation perspective, right? When you have a platform, there are so many different ways to see value in terms of the productivity of that platform, what you think that platform could do for your organization. And also externally communicating to investors, right? It's better received typically when there's a platform deal, right? I'm gaining this huge capability. I now have this option. You mentioned that value can be destroyed, and maybe that does happen in practice. But when you think about what you are messaging and what is the vision you're putting forward, there tends to be a lot more investor receptivity to adding a platform and capability set. But then also there is the kind of intangibles. Yes, there's a productivity of the platform you can be adding on, and you pay value for that. Tony mentioned gene therapy, right? We saw people paying for really manufacturing capability and almost leapfrogging where someone else might be in terms of the competitive dynamic by just buying your way into a certain technology. So I think there's, from a buyer perspective, platforms are very attractive for that reason. And again, very well received by the market typically.
Yeah, and it was more about most times a partner or pharma who buys a company with a platform don't end up utilizing it to the fullest. Maybe they're using the early things that had no value in the public markets, and they're using that, and they're not actually using the platform. They're just taking some of the earlier programs, and maybe that's not transparent to the rest of us. But typically, I think there's been a lot of leakage there.
I think that part of the issue there, if you're acquiring a platform, is it depends on the nature of the platform, right? And who actually can exploit it. And so it gets to something Tony was talking about earlier about talent leakage following a deal, since people's options get paid out and everything else. If there's a research organization that's required, do you have the internal capabilities to continue to exploit it, or are you then dependent on the employees of the previous company, almost as an acqui-hire, to be the group that can continue to be able to execute, to be able to continue to spin things out of the platform, to get the flywheel to continue to move? And it adds a level of complexity to the M&A, where you're giving leverage to another party, because if what you really need is to have that one person who understands how to do that particular piece of chemistry, then they have leverage, and there's a different package that they have to get. And I mean, I think even from background as a lawyer, we saw times where a basic scientist actually had a lot of power over a deal, whether the person realized it or not. And so I think that when you're just acquiring a product, most companies have the capability to advance a product on their own, especially once it's in clinical stage, as you're doing the tech transfer and everything else, and it's just simpler. If you're looking to do a platform, it's not just, are you going to bother to invest in it or anything else, is you have the capability to even exploit it.
So we're running towards the end here. So if I could ask each of you in maybe kind of 30 to 45 seconds each, if there's one takeaway lesson you wanted to share as a best practice with the audience, that I would appreciate that now, and then we'll wrap up. So I guess go with you, Tony, first.
I would say when it comes to a trusted advisor, those words are not easy. Being a trusted advisor takes years to sort of earn that role comprehensively in a company. And so when you really have that relationship, you lean on it. And you lean on it for them to help you avoid mistakes if they're really good on their game, and help you really want to build a company as well. So we talk about, there's a lot of transactionality to advisor relationships, but there's also company growth elements to it. So I encourage everyone to look at trying to hire, investment bankers with that in mind, who will work hard for them between the deals.
Cool, thanks. Naomi, you want to share some lessons?
Yeah, I was going to build on that, and I think it's important to note that, of course, this is very much focused on licensing transactions, M&A transactions. But I think part of a comprehensive perspective in an advisor's job is sometimes the best option is no transaction at all, and make sure we're thinking holistically about all of that. Sometimes the best option is continuing to fund in the standalone pathway. So even outside of what we're discussing, it's important to think holistically about all of the options available.
Yep, totally agree. Andy, any final thoughts?
I was going to say partly what Naomi said, where, just because the deal's in front of you doesn't mean the deal has to be done. And having an advisor that's willing to be honest with you and tell you when something's a good idea or not, and help you understand what your alternatives are to doing a deal. I mean, it's rare to find somebody willing to tell you, especially from an advisor front, I'm going to forego that success because it's the right thing for you. But somebody who actually can do that and is willing to do it because they know it's in your best interest is something to continue to focus on. I think the other big thing as well is knowing how long processes can take to get to the ultimate transaction. It's important to remember that you have to understand how to maintain the cadence with the potential counterparties, with the potential partners, acquirers, whatever bucket you want to put them in, call them, to keep them educated as to what you're doing. There's a lot of companies that are out there that are working on a lot of interesting things. There's a lot of trials to stay on top of, a lot of products to stay on top of, and helping them work through their own processes is going to end up with a better outcome. And so it's understanding, how do you maintain a proper business development cadence in terms of how do you update people? What do you tell them so that when it comes time to maybe talk about a transaction, you're ready to go. You don't want to talk about it too soon. You also don't want to get caught flat-footed.
Cool. Well, we're out of time now. So I really appreciate everyone joining today. Thank you three for joining. Insights were awesome. Really blown away. This could have been a 3-hour panel from my perspective, given all the things we didn't even get a chance to cover. So thanks for everyone for participating, for dialing in. As a reminder, a link to the recording will be sent via email to everyone who signed up. It'll also be available on YouTube, so we'll all be YouTube stars. If you want to read the white paper about getting the most out of your crossover round, we actually have another couple of webinars that we've done recently about crossovers, thinking about that, thinking about the impact of partnering in public markets. That's also on our website, but obviously the white paper here is available for download. We look forward to seeing you all, hopefully in person very soon, maybe even JPM, who knows. But thanks a lot and have a great day.